here we have the Bursa's definition of what an exchange-traded fund is. It is an open-ended investment fund listed and traded on a stock exchange. I know in Malaysia we love our food, so to use a bit of a local parlance, an ETF is a bit rojak. We are merging together the features of a unit trust fund or an investment fund together with the tradability features of shares on the stock exchange. So essentially what happens is units in this fund are bought and sold on the stock exchange. So that's generally it in a nutshell. It's a very, very simple concept, but once we start getting into the details, you can see how interesting ETFs become. So Taki, if you could have the next slide, please. This diagram encapsulates what I've been trying to say. An ETF hybrid instrument. It's a little bit unit trust, it's a little bit shares, combining in a way the best of breed features of both, and just inserting a lot more transparency and a lot more fluidity into the trading process as well. So the next slide will actually talk about the key differences between unit trust funds and exchange traded funds, or ETFs. And let's just go through this one by one. Can we go two further forward? The next one. Yes, there you go. So unit trusts are generally bought and sold through unit trust agents, and the price is quite unknown when you're buying it because unit trusts rely on this concept called forward pricing. So the price is determined at the end of the trading day. Conversely, with exchange traded funds, you buy and sell them through your local broker the way you would ordinary shares that are listed on Bursa. At the point at which you buy the shares, you already know the price. So there's no forward pricing mechanism. It's real time. You've got bid prices and ask prices that are quoted, and you know the price at which you're buying. With unit trust, the investment is deducted upfront. With ETFs, just like buying shares, the amount is deducted from your brokerage account T+2. And similarly with shares, the sale proceeds are also paid to you T+2, and these follow Bursa's prescribed settlement timelines. Whereas with unit trusts, when you redeem your units, you're within a 10-day period. The most interesting part, I think, or rather the starkest difference between unit trusts and ETFs is also in the pricing. So when you buy unit trust, you pay a sales charge, and depending on the type of fund that you're buying into, your sales charge could be up to 6%. Whereas with exchange traded funds, you pay the same way that you would pay when you're buying shares. So there's a brokerage fee, which is generally about 0.7%. You've got your clearinghouse fee, that's about 0.03%. And there's also stamp duty as well. The good news for investors is that at the end of last year, a gazette was passed to exempt stamp duty for purchases for trading securities on Bursa until the 31st of December 2025. So there's another more or less 4 years of this exemption left to go. With unit trust funds, the management fees can range from 1% to 1.8%. And that's because of the active management part of it, whereas in the ETF, they are generally more passively managed. So the management fee tends to be below 1% per annum. And with unit trust, there's a bit of variability in how the dividends are treated. They can either be paid out as cash, but generally they tend to be reinvested into the fund. Whereas with an ETF, the dividends are paid out as cash. So that nicely delineates what unit trust funds are and what exchange traded funds are. So now allow me to backtrack and get a bit more deeply into the concept of ETFs. So Taki, we can track back 2 slides. There you go. So we know what ETFs are, how they are traded, but what are they actually? An ETF, the aim of an ETF is to produce a return by tracking or replicating a certain index. There's no aim to try and outperform. It's just you track the index and your performance is based on the underlying index. So if you have an ETF that is designed to track, let's say, the FTSE Bursa KLCI, then what happens is the ETF provider will buy and sell securities to track the constituents of the KLCI. got an example list of the constituents opposite index: Top Glove, IHH, Kenanga, Public Bank. So the ETF provider will actually track the index and buy and sell securities within that index to replicate or to mimic the underlying index. Whereas the unit trust, as the statement there shows, it's designed to outperform a benchmark, and that is really subject to the skills of the fund manager. And you will be hearing from our fund managers later. So next, Taki. So how does this work really? You've got the broad market, you've got all the stocks listed on Bursa, and these stocks are then distilled into an index which is designed to represent the broader market. So you've got perhaps the FTSE Kuala Lumpur Composite Index, or Dow Jones. Dow Jones has created an Islamic market index as well to represent the Sharia compliant stocks. So from there, now you've got the index. Your investable universe has gone from the entire market to an index, which is a much more specific list of securities designed to represent the broader index. From there, then you start to buy and sell the stocks that constitute this index to make up your portfolio, your ETF portfolio. And that's what the fund manager does. We track the index, we track the constituents, and we buy and sell to ensure that it mirrors as closely as possible. And from there, then you can see how we have distilled from the large Bursa investable universe, broken it down into very specific segments. From there, then created an ETF portfolio. So whereas a benchmark is measured in terms of an index, which is basically the sum total of the prices of the securities. For ETFs, performance is measured in price, but the value of the ETF is measured by NAV, which is the sum total of the holdings of these securities. Next. So, having heard all of this, what are the benefits of investing in ETFs? Moving from left to right, with the most obvious, the low cost. I have mentioned before that with unit trust funds, your fees upfront can be up to 6%, whereas you don't pay anything upfront when you buy ETFs. Likewise, your brokerage fees, your clearing fees, and all that, these are all paid at the time you transact. Whereas with unit trust, you pay an annual management fee. Now, access, I will come to this in much more detail later on, but ETFs by design are designed to provide access to asset classes which are otherwise maybe not able to investors or retail investees by units of 30 different shares of companies listed on Bursa. Even less so, we may not have the access to get exposure to very specific indices, technology, such as technology classes or very specific commodities, for example. So what an ETF does is it acts in a way as a proxy or a representation for actually investing into these securities. In a way, the investment manager or the ETF provider is the one who does all the heavy lifting for you. And it provides very instant, very easy, straightforward access to very interesting, very unique, and otherwise quite inaccessible asset classes as well. Another benefit, of course, is transparency. On a daily basis, the ETF provider discloses the entire portfolio holdings, and from there, then the daily price basket is calculated, and so on. So at any given point, you have full knowledge of what the ETF portfolio is, basically what the constituents are, what the weights are, and what the prices are as well. So this kind of transparency is not really seen in unit trusts, except for the periodic reporting which are required. Aside from that, that level of transparency is quite unique to ETFs. To a degree, I would say that ETFs could potentially even be more transparent than investing directly into shares. And of course, liquidity. You can buy and sell units in your ETF at any point in the trading day, and the price is known, fully transparent. And as a result of that, you are really empowered to sort of take charge of your investment, in the sense that you can buy and sell depending on your investment horizon, on various other factors as well. Sometimes we all have liquidity needs. It's very easy to liquidate, and sometimes you could be feeling particularly bullish. It's very easy to buy in as well. So it's very empowering in that sense. All that being said, I think it's very, very pertinent to touch on the risks of investing in ETFs. And these are some of the major risks. One is, of course, the units in the ETF may actually trade differently from the NAV, and there can be a divergence between the net asset value and the actual traded price of the NAV. An easy way to think about this is the price divergence, for example, of the book value of a company versus its share price. That can happen for various reasons. A lot of it is actually due to liquidity. When liquidity is lower, the price divergence tends to be a bit higher, and when volatility is lower as well, your spreads tend to get a bit wider. So there are various factors that actually determine how closely your net asset value and your market price mirror each other. Of course, the other risk is that as an investor in an ETF, you invested in the markets. So various factors that affect the markets that not necessarily affect your ETF itself could also have an impact on the price performance of the ETF. And there is always that likelihood of experiencing losses due to factors sort of really beyond anyone's control, extrinsic factors that affect the financial markets. Again, another ETFs is also the suspension of creating and redeeming units, and that is because the market makers, in instances where they are unable to create or redeem units, basically what happens is repurchases or primary issuances can be quite impacted as well. So when that happens, redemption or creation of units may be suspended as well. The fourth risk, tracking error risk, that sort of relates back to what I was mentioning before, that there may not be a perfect correlation between the NAV and the benchmark. So before this, it was comparing the NAV and the price of the ETF, the traded price. There are times as well when the net asset value of the ETF may not be perfectly correlated with the benchmark. And there are various reasons for this, which I believe the fund managers will get into after, but the divergence can be for various reasons, structural reasons as well as liquidity reasons as well. And finally, there's also a liquidity risk. It's not the first time I'm mentioning the phrase. So if there's a very, very quiet sort of market for ETFs, or if the market deciders are not market making anymore, then there's less of an active market. And as you all know, as from investing in shares, when there's not an active market, the bid-ask spread gets a bit wider as well. There may not be takers at the price that you want to execute. So various issues like this can arise. So it is very important, Zul mentioned before, choose wisely. It is very important to go in with your eyes open to know that these are actually risks of investing in ETFs. Now, with that, then what do you look out for, right, when you choose an ETF? Let's start with the middle part first, because this is probably one of the more important things that you need to evaluate. What is the tracking error? What is the tracking difference? There are times when an ETF perfectly or near perfectly tracks the index that it's supposed to be tracking, which means any changes to the index are perfectly replicated in the ETF. And as a result, there's a very, very small tracking error. What that is to say is that your ETF is almost exactly replicating the index that you wanted to track. There are times when this doesn't happen. And this again may not happen because of issues with the liquidity of the underlying securities itself and various other factors that could actually be beyond the fund manager's control. So when you're choosing an ETF, you want to look for an ETF with as small a tracking error as possible. And then, of course, you've got the total expense ratio, which, if you know from investing in unit trust, it's what is the total expenses of the ETF versus the net asset value as well. And as we all know, the lower the total expense ratio, the more efficient the fund manager is and the fund house is in running the ETF. And as a result of that, efficiency will translate to various factors such as growth in net asset value as well. So the lower total expense ratio, the more efficient the ETF. And finally, we look at things like index strategy. You need to think about or consider, how is this index constructed? And does this index construction, does this strategy sort of jive with my own risk profile, my own goals? And these few phrases here, market cap weighted, smart beta, tracking a certain theme, we will come into this shortly. But it is very good to try and understand the construction of the ETF, the strategy. What is this ETF all about? And again, to weigh that up against your own risk profile and your own goals. One of the other factors, okay, so that's fine, Taki. You can move on. So speaking of strategies, there are a few broad categories of strategies in the world of ETFs. So moving from left to right, you've got equity, fixed income, alternative assets, leverage and inverse ETFs, and actively managed ETFs. So if we start from just very, very simple equity ETF, these are things that you're most likely familiar with, where you try and track a benchmark index that's comprised of equities. And then you have something that's a little bit more unique called the fixed income ETFs. Now, the fixed income ETFs are designed to track the performance of a specific bond market index. And the bond market index, like any other index, is a statistical composite that is designed to track the performance of a specific sector in the bond market. It could be tracking government bonds, could be tracking corporate bonds, could even be tracking mortgage-backed securities. And they also can slice it up by maturity or credit quality and various subsectors within the fixed income market as well. And then you've got alternative exchange traded funds as well, which gives you exposure to various alternative investment categories as well. And we have seen alternative ETFs that track hedge funds, that track long and short managed futures. There are even ETFs out there that track private equities or venture capital. They track real estate, commodities, gold, silver, etc. So that just goes to show the ability of an ETF. Its strategy is really a world of infinite possibilities. It really depends on the insight, creativity, and ability of the manager to look for where can we find these returns. What strategies will give us returns that are interesting and compelling to our investors? Now, inverse and leverage, or leverage and inverse LNI ETFs, these are what we call synthetic ETFs, where they use derivative products to really represent the underlying shares. So, for example, a leveraged ETF would actually use derivative products such as options to magnify the gains that you get as opposed to investing directly in securities. So as we all know, options are very, very cheap to buy. Their price movements are very, very high compared to the underlying security as well, percentage-wise. So for the same amount of investment, if you invested into options, automatically leveraging your returns as opposed to buying the ordinary shares. Now with the world of derivatives, then there's the inverse of that as well. Similarly, options can be used to synthetically short securities. So if you had a negative or contrarian view of the market and you invested in an inverse ETF, as the market goes up, your investment value will come down, and vice versa. So if the market were to come down, then your investment value goes up. And finally, we have this very, very broad category of actively managed ETFs. And actively managed ETFs are very different because as the name suggests, they're actively managed. So instead of passively tracking an index, the ETF that is actively managed will have a benchmark index, but the manager may change the allocations. They may not exactly mirror or replicate the index, but they may deviate from that as they see fit. And as a form of actively managed, there are various forms of actively managed ETFs. For example, you've got a thematic ETF. And a thematic ETF is, investments in certain themes, such as robotics, artificial intelligence, environment, sustainability, healthcare. Now, these may not all have indices, so it's really up to the manager to actively manage the allocations. And under actively managed ETFs, for example, you've got what we call, sorry, Taki, just back slightly. Yeah. You've got what we call smart beta ETFs as well. Smart beta ETFs, they typically don't employ the typical market cap weighted. They may take into account other factors as well, such as various metrics. The smart beta ETF may actually, instead of looking at market capitalization, they could look at the fundamentals of the company or various other factors, such as your balance sheet components, your valuations, growing companies or not growing companies. So in short, I think what this page encapsulates is there are many different types of ETFs. And again, it's unlimited field of possibilities on what exactly you can track. And the directions in which you can profit as well. You can profit from upwards movements in the market, downward movements, depending on your horizon and your outlook as well as the manager's outlook as well. So if you decided to invest in ETFs, where can you get information on the ETFs? There are various sources of information. One is, of course, Bursa itself. And then the ETF providers will generally have their own sources of their own websites on which the ETF information, the daily prices are published. This holds true for all ETF providers as well. I'm not sure how much you can see on this slide, but in the boxes here, we've got several different columns, which I think will be somewhat familiar to you, which is the bid price and the ask price, very similar to when you're trading shares. And of course, there's another one called IOPV, which stands for Indicative Optimized Portfolio Value, which is basically the theoretical values. The movement of the shares that constitute the index are constantly moving. So every 60 seconds, that's right. So every 60 seconds, we will actually publish the theoretical value of the portfolio based on the constituents of the portfolio. And then when you look at it side by side, you can look at the bid and ask prices versus the IOPV to see whether there is actually a genuine, the traded prices of the ETF, whether how closely does it mirror the actual index or portfolio itself, which is a very useful metric for investors who are considering investing in ETFs. So, liquidity has been a very big talking point when it comes to ETFs, right? A lot of people have this preconception that ETFs are not liquid, that if I bought ETFs, I'm going to get stuck with them, I cannot sell them, or if I wanted to sell them, I may not get the price that I want. But by design, the ETF industry is actually designed to be liquid. And how this is done is an ETF issuer works with market makers, or what we call liquidity providers. And these liquidity providers are there to actually, much like shares as well, to generate liquidity, to post the bid and ask spreads, the prices, and to make sure that there's no major divergence in the prices as well. So by design, then an ETF provider can actually increase and decrease the number of units in circulation just to ensure that the liquidity is at an acceptable level. So in the regulations, it is prescribed that an ETF issuer needs to have a liquidity provider. And a liquidity provider is a bit of a catch-all term for two major parties here. One is called the market maker and one is called the participating dealer. Now, if we look at the participating dealer first, they are largely responsible for the primary issuances of ETFs. So when there are new issuances, new creation of units, the participating dealer are the ones who are responsible for the issuance and putting that onto the market. And likewise for cancellation of units as well, whereas the market maker tends to operate more in the secondary markets. And in the secondary markets, they are the ones who really do the intermediary function. So they are the ones who quote the bid and ask prices, and they are the first also to apply for creation of units as well. Largely, the liquidity provider's role is to ensure that the market price of the ETF does not deviate too much from the underlying index. So it's the effort of the liquidity providers, such as the market makers and the participating dealers. It is hoped that the liquidity of ETFs is probably not as bad as the perception that people may have out there. There are certainly mechanisms put in place to ensure that liquidity is at an acceptable level. So that's it for me. Thank you all for your time, and I hope it's given you some insight into what ETFs are and into whether it gets you thinking about whether it should be part of your portfolio. Feel free to post any questions, and I shall hand the floor back to the moderator. Thank you.